Hello, you're listening to Ready, Set, Go Real Estate Investing Podcast, presented by Brandon Elliott. This show will be going over all aspects of real estate investing and is intended to educate, motivate, and prepare you to take action on your first or next real estate investment. For more information, please visit BrandonElliottInvestments.com. Thank you for listening and enjoy.
Welcome back, everyone, to Ready, Set, Go Real Estate Investing Podcast. I'm your host, Mr. Brandon Elliott. We got somebody that from New York to Florida, just recently moved to Florida, but has been focusing since 2019 as a real estate agent in New York. Still, I believe, holds his license as a broker and so forth, but really felt the need to help out his clients more by giving them opportunities to put their capital to work in different investment opportunities. So he actually started in 2023, just last year, about 18 months ago, really focusing on setting up a fund and becoming a fund manager and helping out over 45 different investors currently and raising a little north of $5 million. Has been focusing on several different projects and putting it to work. So I'm excited to hear the journey from, where you originally came from to with that mindset of real estate and agent to where you're at today and kind of what sparked up all that. But Nishant, how are you today, brother?
I'm doing well and really excited to be here, Brandon. Thanks for having me over and big hello to your audience as well.
Awesome. Thank you. I appreciate it. So talk to us. Why real estate? You jumped in 2019. And for anybody, I guess, out there that doesn't know, more of a 30,000 foot view of who you are, where you're from, what you're up to, that would be great.
Sure. Actually, I was born in the US, but I grew up in India. So it's only in 2018, when I was 29, I came to the US. And being a US citizen, I always had this dream back on my mind that at least I want to go to the US once and give it a shot and see how life is over there.
Was it New York that you were from?
Yes, I was born in Long Island, New York. I was there for the first couple of years and my parents decided to move to India at that time. So 2018, I came to the US and for the first 12 months, I was hustling to get a job. I got a job in a healthcare startup, but I was just really enamored by seeing the big buildings, the dreams, New York City, the energy, everything, the hustle, the culture over there. And I started to attend conferences in Times Square and going to, buying $10 tickets and just learning more and more about the world of real estate. And I just saw that there's so many opportunities from wholesaling and fix and flipping. You can become a broker. There's so many ways you can really get involved, multifamily investing in the real estate space. And I started to dig deep into YouTube videos and I saw there's just so much opportunity here. And early 2019, I was still doing a job. I didn't have, the kind of capital. At least my limiting belief that time was I need a lot of capital to get into real estate investing.
So I think everybody knows, right? Everybody thinks that originally. I need a ton of money to get started in real estate, and that isn't always the case.
Exactly, and didn't realize how much sweat equity and hustle really goes in. So I thought at that point, okay, I'm in Manhattan. What can I best leverage? $1,000 startup fees to get a real estate license didn't seem really expensive. And if I had the opportunity to start selling $1 million homes. So that's when I jumped in straight up. So I didn't have any network or anything like that. I grossly underestimated how difficult it will be because I just thought that people are waiting to hire me to sell their homes and I'm going to be this guy coming on television now.
Yeah.
But
it's a little bit more difficult than that, right? It's a little bit more difficult.
A lot more.
Yeah.
A lot more. And there's sharks sitting over there already. And every real estate market, in fact, in the US. So 2019 was hard. 2020, of course, COVID. But by the end of 2020, I got a good traction. I built a good practice 21, 22. But, one thing which kept coming up again and again was that I was looking, while it was very fulfilling being a real estate agent in New York City. And it's good fun selling those expensive properties, meeting highly successful clients. But I saw a bigger problem statement because most of my clients were in the tri-state region, New York, Connecticut, New Jersey, and people were wanting to do something in real estate outside the tri-state region because New York and New Jersey are fundamentally expensive markets. So what do you look at? People want to do something in Texas, you want to do something in Florida, and you just keep hearing things. And almost every time I would get up, like both personally and professionally, my clients or friends would ask me, hey, do you know of any good deals? I have this extra 50K or 100K lying with me and I want to do something in real estate, but I'm busy. I don't want to be a landlord. I want cash flow. So I saw a consistent pattern, and that's when and also when the mortgage rates were rising, I saw this as an opportunity that I could potentially pivot from being a real estate agent to helping a bigger audience, potentially throughout the US, maybe international as well, to start investing in commercial real estate. So that's kind of my journey from an agent to now a fund manager. The natural aspect of being a real estate agent is you build a network. And then you if you can start addressing that network and scale, you can expand into different avenues.
Yeah. Yeah, it's funny how so in a lot of those states right there, they're all blue states, and all the investors really want to invest out of state into red states to really get the best bang for their buck, plus the security and safety on the investment. So when it comes down to the agent side of things, are you still doing that today? I know you are still licensed, correct?
Yes, I am. So I just have another 12 more months. So of course, when you've been in the business for about 5 years, you do build some goodwill. I have a good network. So I have partnered up with other agents to help with showings, etc. But I'm not really actively prospecting for new business. So it's not that I'm actively marketing or spending energy, calling for referrals. I use the same energy to get in touch with my network though, but for more activities to do with investing in syndication projects across the Sunbelt region.
Okay. And then are you planning on extending your license and, keep paying the renewal, as well as where did you hang your license originally?
So I started off with Keller Williams in 2019, but now I'm with Compass. And Keller is a great brokerage for training, but I moved on to Compass. I don't plan to. This is something which I'm still visiting because I want to be laser focused in the fund management business, but there's a high probability that because of the goodwill I've built, I make greater referral model where I can, if any clients, past clients are looking for people to buy in New York, they can always refer them to my colleagues in the industry and potentially work through referral fee. And that way also gives me an opportunity to be involved at some level, right? To know what's happening in their deal. I think I value those aspects, but my focus largely now is on multifamily.
Okay. And then how many transactions did you do as a real estate agent before deciding to switch over as a fund manager?
Sure, that's a good question. So in the last 4 years or so since I've been a full-time agent, I did somewhere around 40 transactions. New York City transactions take slightly longer than your typical ones because we have process of co-ops, condominiums. Just to let your audience know, the essentially an application process before you buy a home. Just add another 2 months to it, can be a lot more tedious as well. Also, price points are a lot higher, somewhere between $1 to $3 million. I know I've given a big range, but typically that's where most homes you're selling. So your sales cycle is slightly longer. But yeah, that's the range. Mostly been a buyer's agent, which I've enjoyed a lot actually. So I've had a good time being a buyer's agent in Manhattan. You get to see all great properties from, I've been blessed to sell from a studio 500K to all the way to a $4 million penthouse in Manhattan. And the reason I say this is that I think the biggest learning for me in working in a market like Manhattan was just meeting a highly successful clients, people who are executives in Fortune 500, business owners. And Manhattan kind of is that melting point, right, for people coming between New York, New Jersey, Connecticut, even Philadelphia for that matter. People pour into New York every day. So I think that learning is something which has really stayed with me.
Yeah. And did you have any friends or family members that encouraged you to do real estate, or how did you get inspired besides just doing research and realizing there's money to be made in real estate?
Actually, they weren't the most excited when I started off because 2019 is when I got married and it was just 12 months since I moved to a new country. And so they wanted something more stale, possibly me working maybe in a consulting job in New York. At least that's what they envisioned, or some tech company. Because I'd done my MBA previously, so that mindset comes, okay, if you've done an MBA, yeah, you should be in a good corporate job. Why would you worry about real estate? And let alone start with brokerage. So starting off with brokerage, at least in India, was slightly frowned upon in the real estate hierarchy of things,
Really?
if you, maybe developers on top or investors, they're like, okay, because just being a real estate broker is seen as a very saturated, commoditized business, whereas it's slightly different in the US. I think it's a highly lucrative business because you can really build a good network. You can own a good farm as well, in terms of where you're living or any area you choose for. And to some extent, there can be some scale as well if you're able to build good systems into place. So it was slightly different because here in the US, the difference is the culture of teams that would come up, real estate brokers really advertising themselves. They're almost mini businesses within a brokerage, right? Because they're all independent contractors. Whereas more in India, it was slightly more commoditized. It's only now, post-COVID, that the culture in India has also started where you'll see real estate brokers using social media like YouTube or having, successful podcasts like yourself. So seeing that trend now, but at least 2019, they weren't really excited about it.
Yeah. And that's funny to say, feeling like it's oversaturated, just because everything I feel like is oversaturated these days, right? There isn't one thing that hasn't been done a million times, but success leaves clues, and you don't always need to reinvent the wheel to be able to hit success. And so it's awesome how you followed your heart. And even though you have your MBA and you have all these other things that can really set you up for a tremendous future, it gives you options, and you don't need to necessarily jump in that still while you're young, jump into some, following your heart and realizing real estate. So at this point, you set up the fund early 2023, and you've raised a little over $5 million so far through 45 plus different investors. How was the process to set up the fund in general? Was it just sitting down with a certain lawyer, paying the money for it and keep it moving? Or what was the education experience, possibly learning curves involved?
Sure. No, that's a great question. Actually, I was fortunate that I was able to build a fund through a platform called Avestor. And they do the legwork to help you not only build a fund, but get the attorneys involved to get all your paperwork in order, etc. And they provide you great online portal as well, so where you can streamline your operations by investors being in one place. They may be able to see your different deals. So I was lucky that I was able to hire a company that almost gave me end-to-end service as well. So they also speak to me about it offline from your audience. I'm happy to chat about it, but just to give you a gist of what it is. So how it was built is a customizable fund. And what that means is that there's a one set of fund documents which are evergreen, and every time a new deal comes, it's like a new exhibit which you can keep adding on. So you enter the fund, but you get to choose which deal you want to invest in. So it kind of gives you the benefit of you investing in single assets within a fund versus it being a blind pool fund, if that makes sense. Because based on feedback which I got from a lot of retail investors still like to be involved in picking on their own projects. For example, they may have done something in Dallas, but they want to go through the webinar. They want to understand, see the deal brochure. They want to know, okay, it's a 200, 300 unit complex. There's a story about it, blah, blah, blah. So I think that educational aspect and the ability for investors to choose based on feedback, I really like the model of having fund, but giving you the benefit of a syndication where you pick on a deal basis. So that's how the fund structure was. Luckily, as I said, luckily for me, I had a good attorney who just helped me through the documents. The company and the CEO of the team was pretty helpful in terms of setting me up in terms of the systems and legal, so that I could do what I enjoy the most, which is talking to investors, creating educational content material for them, and have the experts do what they are good at.
Yeah. That makes sense. So you used a company, Avestor, and
yes.
And do they take a piece of the company or anything, or is it just a flat fee that you pay one time?
Sure. So just to give you your audience some perspective, give or take, the startup cost is around $18,000 to $20,000 if you go over to the Avestor portal. So about $10,000, which is a negotiated rate, which from an attorney, which could have been 20 plus, but because they're doing that at scale, you get a discount, and about $8,000 to $10,000 are their startup initiation fees, and then you pay small monthly fees every month to the portal based on how much capital you've raised. So of course, as your business grows, your fees also increases. but that's in direct proportion to how you're growing, right? Just to give context, I think the startup fee is between 18 and 20,000. But good news in a fund business is that investors who are coming on board understand that, because just the good legal documents and everything which you're creating, good portal is something which is of good use to everybody. So you have investors also contributing to it to help you run it successfully.
Yeah, and at the end of the day, you want a good fulfillment, funnel so that people can actually see where their money's at, updates, and so forth. How often are you giving updates?
So we like to give monthly updates as much as possible, though I look from my perspective, because I'm a limited partner investor myself. Essentially, I'm not boots on the ground, and the general partners, they're the ones who are doing all the legwork. So I'm getting monthly updates, quarterly updates, which I share with my investors. I feel more value in quarterly updates. The only reason being that there's a baseline to compare, right? Because on monthly basis, it's just too soon to see any big delta.
Progress.
So I think the quarterly, exactly. So I think quarterly updates is good. Sure, while I do appreciate in general partners sharing monthly updates, kind of holds them accountable. I think from an investor perspective, it's also important to give them enough time to work on the project and make substantial improvements, so you can hold them accountable accordingly.
Yeah, there's only so much that can get done in 1 month when you're talking about big projects. So yeah,
exactly.
Give it 90 days and you can actually see some traction and some efforts and energy moving in the right direction.
Absolutely.
I love that. And then so you were mentioning with Avestor, it's about 18,000 to 20,000 to get started. And then after that, there is a monthly fee to have the portal and keep everything existing. And then what is the percentage that they are holding on the monthly basis that they're charging? And then at the end of the day, the type of fund that you have here, what reg is it?
So we are doing a 506C fund. So it's primarily for accredited investors only. So I can do accredited investors, just, let your audience also know, is that anyone who's making over $200,000 a year, or husband and wife combined making $300,000 a year, or you own real estate worth $1 million apart from your primary home. So essentially, most people qualify in the first or second scenario. Or I also do 506B funds, which are 506B funds. Essentially, you don't need to qualify for these three financial scenarios, but there has to be a pre-existing relationship. So for example, maybe if an investor and I have had already a phone call before and there's some kind of relationship established, plus some email exchange. Essentially, what the SEC is trying to see is that you're not soliciting someone without a relationship.
Yeah.
Right. If the relationship is established, there's some level of confidence already going. In that case, you don't need to necessarily meet this criteria, but I still can only work with accredited investors in my fund. At least that's how I've done it. And there's reasoning for it as well, because most of my deals have a minimum of $50,000, and that's quite a sizable check by all means, because for some investors, of course, I've had investors come at 150, 200,000 plus as well. But, for first investments, 50 plus K can be sizable. So it's important. I feel that, you qualified in a certain realm. I believe SEC might also be adding an exam in the future, just in case you don't qualify financially. At least by giving the exam, you should understand your investment, because these investments come with risks.
Yes. And then so 50K minimum, does Avestor help out with the tax filings or payouts and so forth within the portal, or is that just bookkeeping, tax filing, and so forth?
They do. So we are very fortunate because they're able to help us. They do the bookkeeping. Of course, we need to overlook it as well. But they also do the tax filing in terms of sending K1s to investors. So K1s are showing your profit losses for your investment. They help you in the distribution. So a lot of it gets streamlined. Of course, as you're growing and scaling and the number of investors you're dealing with are increasing, you'll need to get in more help just to make sure the customer experience is good and you're not missing out on anything. Because as soon as you enter the fund world or anything to do with the SEC, your compliance becomes of top priority. Not only for you, but you also have responsibility for your investors. So it's always, while yes, the portal and Avestor is great in terms of doing a lot of the heavy lifting, but I think from a responsible fund manager's perspective, at least how I look at it is, we need to have our own team to be checking and making sure, because we don't want our fund to be coming under any compliance issues, nor do we want our investors to have any problems.
Yes, that makes sense. Okay. And then, so talk to me about some of the deals that you've invested in so far. Because I mean, the fund is somewhat new, a year and a half. How many deals have you invested in? And where do you find the partnerships? Because you're bringing the capital to the table. You raise the funds. So now it's your job to find some good partners that actually have great opportunities, right?
Absolutely. I think that's primarily from an investor's perspective. Why they work with fund managers is because they want vetted opportunities. So they want to make sure that you as a fund manager probably evaluate, get 100 deals on your desk and maybe 2 pass your litmus test. Okay, just give me an example. And that's actually true. Second is, you have a due diligence process in place set, where you have a certain level of checklist which you go through to ensure, and again, I'm happy to discuss more in detail as well, so that the deal passes then. And finally, and probably the most importantly, what's in it for the investor? Because, hey, am I getting preferential economics or somewhere of a better split working with you than going to the operator? And I think that's important for investors to know, that a fund like mine comes, if you're coming with 500K, $1 million or $2 million in a deal, you tend to have slightly more negotiation power with the operator. Just to answer your question in terms of how we're looking for deals, so I do a top-down approach. First and foremost is identifying your markets. It's very important, and it's important to be disciplined as well. So I kind of keep a very simple approach and then complicated. I look at U-Haul and I see which are the states where people are migrating to most. Basic data information I look into, because end of the day, real estate is a location-driven business.
Yeah,
people are migrating, job growth is taking place, there's going to be more demand. So you want to meet that demand, right?
So that's a big takeaway that people should be writing notes on this, because you just dropped some gold right there. Looking at certain places like U-Haul, right? Or budget truck or whatever, where are these trucks? Where are people moving to, and where are they doing the one-way trips, right? And so that's where you're going to find job growth, population growth. You're going to find something unique about that area that you want, that is a good leading indication of, hey, this may be a nice area, a nice location that we should consider investing. So how do you find that type of data?
Sure. So how I stick with it is that I have a few criteria which I look into. Like you mentioned, first you want to look at states which are more landlord friendly, especially if you're going to multifamily rentals. Okay, if you're going to new development condo sales, that's different, and that's a very small market which I work on. But so based on that, the markets I have really boiled down to is Texas, Florida. Those hard to pencil these in Florida nowadays, North, South Carolina, and Phoenix. And now once you're able to identify your states, you want to identify certain locations like Dallas, Houston, Charlotte, Phoenix. Okay, another filter. Then I keep throwing on these filters out there. Now, once I've identified my markets, I need to find the top players out there. How do I identify the top players now? That's the next question. Great place to go for conferences, because that's a good opportunity to meet operators over there in person to person. Just something for your audience as well. The larger these real estate projects, it's better that they are locally based. So because I've been a broker myself, I understand the importance of local knowledge and expertise. You can be, if I was in New York City, I was just good in selling maybe Upper East Side Manhattan. I didn't know all the 5 boroughs, for example, right? So if I'm working somewhere in Dallas, what's your track record in Dallas? Do you have your own property management, your own construction? How many deals have you exited? What the kind of returns you give to investors? So if you have a few filters which we look into that, okay, we are probably a top 5 player in that market. Also, I'm part of a fund managers group where you're about 100 fund managers and other different GPs come on a weekly basis to pitch their deals. And then we as a group do due diligence together and negotiate better splits. So this way, good deal flow is also coming, and we're able to compare different deals before we send anything across. Also, if many times when I've identified a very good sponsor, I reach out to them directly. Yep. And I reach out to them directly through LinkedIn. It's fairly easy to, find people's contact information through podcasts, and, you can always initiate a conversation to see that, okay, they're looking for good capital because that's going to help them scale, as well as looking for good projects. So, there are different avenues, I would say, but the fundamentals remain that, okay, are you locally based? How much of it are you doing things in-house? What's your track record? Have you done, I really don't want to be a first play. I respect, I'm an entrepreneur myself, but I don't want to be the first, second shot for you to give it for you to try this. You should have done this quite a few times successfully, and for us to at least have a conversation.
Yeah. If they have failed in the past on something, is that something that you will acknowledge and still work with, or what is, what's your track record with that?
So from my perspective is that I don't like to work with GDs who have lost money, because that's a red flag for me. I also tend to avoid GPs who do capital calls. Capital calls, just to give context to your investors. Let's say I raise money from a bunch of investors or project, you're in a certain budget, but you've just, your budget's gone haywire and you need more money to just pay your debt. So just keep the project running. So that doesn't give me much confidence, because at that time it shows that, you really didn't factor different external factors in. You definitely weren't conservative in your approach.
Yeah.
So I'm okay if, you've had certain deals which have not hit your targets, but I want to know the story behind it.
Yep.
Were you able to sell it before the mortgage rates went high? Great. I gave investors less return, but I gave a faster return. That shows me confidence. Is your overall average return still high? Okay. That gives me confidence as well, because sure, out of 10 projects, if 2 haven't done as well as you like, 3 to 4 are going to hit it out of the park. By and large, is your portfolio giving above average market returns? Because these are, end of the day, private equity projects, right? These are private real estate investment placements for investors. So they are not looking for returns which they can get in public markets. You have to beat that. If you're going to be giving returns similar to S&P 500, why would they be interested in investing with you when they could go for a much safer option out there, right? So you need to give something which is a lot more compelling to them. So yeah, I'm not totally against if you don't hit your goals, your projections, but at least I need to know the story and I need you to acknowledge it.
Yep. What about the last several years when interest rates just started going crazy? Like a lot of the multifamily markets and syndicators, they had a lot of issues. They weren't betting that the interest rates were going to do what they did. And I know they've been promising for a long time now that the interest rates are going to start coming down. We've seen a little bit, but I'm curious. There were several companies out there that were doing capital calls or going under, and having some issues. And I'm assuming that there's going to be many more. But what are your thoughts on that?
That's a great point, because what happened in 2020, 2021 also, if I may add, was when the interest rates were down, the market was on fire, right? So you're getting extremely low cap rates. You're getting the kind of pricing you could ask for, quick turnarounds, very low entry barrier into the business in terms of syndicators. More and more syndicators were coming in. New multifamily operators coming. I think that was a problem, because when the times are good, people assume it's always going to be good. And a lot of these folks came in floating rate debt. Essentially, just to give your audience perspective, is they as the interest rates to be variation in interest rates based on how the market is going. So when the rates started to go up, they didn't really factor that in, and it gets hard for them to pay your loan back, right? So also rents were not going up in the last years the way they wanted to. So now what's become a situation is that a lot of new players are getting washed out who didn't plan for this. And this has actually opened up an opportunity, because, for example, KKR has recently taken a $2 billion bet on multifamily. They've done, I believe, 18 purchases recently. A lot of the big firms like Blackstone are sitting with dry powder to buy a lot of distressed real estate. We've recently done 2 distressed deals, and we have one coming up again. Yep. Just to give context, distressed is when sellers are forced to make a sale by the lender because they break a few debt covenants. It could be your expenses have gone a lot higher than the ratio which is acceptable. That essentially puts the deal on risk. You've not been able to service your debts, things of that nature. Lenders come into foreclosure situations. So at this point, as we're recording this podcast, we are looking at pricing from the peak of 2022. In April, multifamily is down by about 20-25%. So you're able to buy at big discounts, but obviously getting loans now a lot harder, raising capital is a lot harder. So these are the factors one has to also consider. But if you look at from the opportunity side, new construction multifamily is down by 50% from last year. I recognize I've given a very big statistic, largely because of where interest rates and inflation go. It's very hard for numbers to really pencil down.
Yeah.
But what we are foreseeing in the market is that in the next 2 years, as and when rates will potentially come down, home affordability is going to start getting more out of reach. rents are going to start coming high in the next 2 years or so. We're in an undersupply market potentially. So it's a cliche, buy when
it's a cat and mouse game. Yeah.
Yeah, it's a cliche, buy when there's blood on the street, as they say, or it's a buyer's market. But it's a cliche for a reason, because it's true. There is that kind of opportunity right now. But again, it's being in this space for 5 years, especially working with different buyers' emotions, buyers and investors. Buyers tend not to buy when there's a falling knife situation. You don't want to be you don't want to be buying when you think that things fall down, but there is opportunity.
Yeah, I love that. So your predictions are, in the next year to 2 years, interest rates will come down a little, but that will also bring a lot of people onto the market, making the pricing kind of bid wars going higher, correct?
Yes, I do foresee that in the next 2 years. Simply just from a demand supply perspective, right? We are not, from using a US housing perspective, just to give another context, in about a few months ago, Fox News or Redfin, one of these sources, and I'm right about it, they gave a report saying that home affordability in the US is the worst in the last 40 years. That's a very big report. And the reason they said was that what happened in 2020 was that when mortgage rates were at 3%, about 70% of homeowners now in the US have locked their rate, below 5% or 4%.
Yep.
So those folks aren't really incentivized to list at that time. In fact, home prices have gone up in the last year because we're in a low supply market by 2 or 3%.
Yep.
And what happened in 2020 is that home prices went up by 25%, give or take. Now, they've not really come down. So the statistic we said, which really alarmed me, was that to buy a median home in the US, a family needed about $85,000. Now they need to make $120,000. So to get home affordability back to where it was, either mortgage rates need to come down at 3%, home prices need to fall down by 20%, or your yearly income needs to jump up by 60%, or a combination of these three ideally, for it to become affordable again. So from 7% mortgage rates, we don't see it falling down to 5%, at least not overnight. We don't see any indication that there's going to be a market crash. In fact, market experts feel that once mortgage rate starts falling down, there's going to be a lot of pent-up demand, and in fact, home prices are going to go up. So a lot of people feel it might become a situation like Europe. What really separated the US from the European nations was that home affordability was very much intact over here. But in Europe, if you go to any of the major metros, you can't really afford there afford that unless you have an inherited home. We don't want to be in that situation, but it seems we're kind of headed there. So people are choosing to rent for lifestyle reasons and home affordability reasons. And I think the next 3 years will be, from 26 onwards, 26, 27 will be very powerful for the multifamily market.
Yeah, that's good. And then, so what if, when you're raising capital and you have $5 million on the plate right now, what if you don't have an opportunity to put the money to work right away? Are you raising the capital after you get the opportunities, or are you just having it in the funds sitting there waiting? And is it earning anything? It's not a debt type of fund, correct? It's more of a equity fund, correct?
Yes, it's an equity fund. I haven't done credit that you get, but I raise on deal-to-deal basis.
Okay.
So just to give your audience perspective, it's like, let's say only once the deal has been finalized, not only from GP, means the guys we're getting the deal together, but also from my perspective, once it's gone through my due diligence checklist, my vetting process, and I am confident about the deal, is at that time I present it to my investors. So I don't like to do more than 1 to 2 deals per quarter. And the reason being is that, and not more than one deal at a given point of time. The reason being is that if you're getting an email or a phone call from me, it should be like, okay, this is a vetted opportunity. At least it's worth me reviewing it.
Yeah.
If I send these on a weekly basis, then it comes more from a commission breadth perspective. At least that's my view. So to answer your question, we raise after the deal comes. So I'm raising on a per deal basis. As soon as investors invest into our fund, we go and invest into that.
And then are you, prior, just when you're out there networking, you are kind of building relationships and getting verbal commitments beforehand. I'm curious, what is the actual percentage of people that say they're going to do it, and then when it actually comes time on the deal, deal to deal basis, not every deal is made for every person, but is it closer to 50% or so that actually decide that once upon a time told you, yes, I'm interested, send me the next one, I'm all in, versus when you actually come around with that opportunity, they're like, things change?
Yeah, no, that's a great question. So from my perspective, what I do is I have a very simple opt-in. I let the investor, anybody know, whoever I meet, that, hey, I do work on about 46 deals per year. These are cash flowing assets with growth potential and tax benefits in the Sunbelt region. Would you be open for me sharing this from time to time? This way you're educated about the market. And of course, if some things of interest, you can have a conversation. So because that easy opt-in is there for people to just join the investor club, a lot of them say yes, but they don't commit for it. They say yes because, they want to enter the shop, but most of them are just window shopping. They just want to see what's out there in the market.
Yep.
But of course, like everything, it's a numbers game, right? The more people like to get into the shop, more people be interested. That's just how it goes. So that's my first process. Second is there are variables for what one says yes to. For example, if I do a deal in Brooklyn and a lot of my networks in New York, I tend to get a lot more interest. But let's say Dallas Fort Worth, people are a lot more interested in these markets. I've seen that investors with local presence tend to have the project which is local to them. They tend to have more confidence to go ahead with it. Also, it allows them to do another level of due diligence, which they wouldn't have been able to do in long distance.
Sure.
But fortunately for me, that once the deal is passed, goes on, they tend to schedule a phone call with me after they review the deal webinar, which could be somewhere between 20 to 45 minutes. And if I get a soft verbal commitment, they obviously have a deadline, but this is on first come, first serve basis. So whoever we may give a verbal commitment, but if you're not able to fund on time, someone else may be able to take your spot. So fortunately, we try to find good deals. So I would still say about, a past success rate would be about 80 to 85% follow through as they've committed. But life happens, for some reason, some people change their mind, they've had a conversation with their friends or family, or they realize they have an expense coming or because in there. That's just the reality of it. So it's always good to have some level of buffer, and also let your general partner or, your partners know that, okay, kind of under promise and over deliver to them so that they know that fund allocations are in place. You don't want to be in a situation where you're not able to deliver the funds in time, which can affect the closing, your reputation, and you're not getting access to good deals. Reputation is paramount to this business. So all of the operators that were top quality. Now I get a phone call from them before it even hits the investor network, reason being because they got that confidence. I've given them small commitments, overachieved them. It may not always happen that I overachieve them, but that gives you confidence that, okay, Nishant is going to deliver on his allocation, so we trust him. And we can probably put the deal in front of them.
Yeah, I like that. Okay, and so you're doing a webinar each time to kind of, get and it's a numbers game. You have a big email list. You have a lot of people that are committed to window shop, and then you show some deals here and there, and then every once in a while when you actually are moving forward with one and you have a certain time commitment behind it and a dollar amount that you need to raise, then you are doing the webinar and trying to invite as many people on there. After that, I assume if they are interested, you're booking one-on-one calls.
Yes, long one-on-one calls. Some investors who are past clients who have that confidence with you, sometimes they just, they're just that busy. They know if I reach out to them via text, they may just ask me to block a position for them, and I can give them a 10-15 minute rundown on the deal. Again, this disclaimer, that's with clients who I've known for like maybe years. It doesn't happen with everybody, I hope so. I wish so, but the education aspect is important. It's important for your audience as well. Every investment comes with risks.
Yep.
And it's important that while we all want to look at the upside, but it's also important that risks are discussed, how the risks are being mitigated, and what your comfort level is. And I tell you to spend more time on that, because end of the day, no one's going to build a business by investing with me one time. It's only going to be that when they get that success, they know that they've walked through the process and feel comfortable, that they'll potentially refer me to their friends and family.
Yeah, that's good. I love it. Very cool. Awesome. Well, this is, just a wealth of knowledge, and excited to see where you've come from to where you're at today, going from the agent side to, a fund manager and helping out a lot of people and making an impact, obviously. So very cool. Nishant, how can people get a hold of you?
So I'm pretty active on LinkedIn. So Nishant Sondhi, I'll share my link with you as well. You can, can add me on LinkedIn. Also, you could visit my website, sondhicapitalgroup.com. And I look forward to connecting with you.
Awesome.
And I have a ton of free resources there. Just if I may add, like our Investor 101 course, which is just basics on syndication. So, if anyone's interested, they can download the report over there as well.
Very cool. Yeah, that's super helpful. Yeah, so guys, I highly encourage reach out to Nishant, wealth of knowledge and doing some awesome things. And if you guys want to get a hold of me, you can always do so on Instagram. It's go to Credit Counsel Elite for Instagram. Otherwise, check out Brandon Elliott Investments on Instagram. And on Facebook, it's facebook.com/Brandon Elliott Investor. If you're looking to learn more about what we got going on at Credit Counsel Elite and how we could better serve you, showing each and every business owner nationwide how to get up to $500,000 in new capital. I'm talking $2, $3, $4, or even $500,000 in new capital at interest rates as low as 0%. We have many different opportunities, education, and showing you how to clean up the credit, boost up your score, position yourself properly in front of these banks to get a closer to a 90% approval odds with the highest limits, best terms and conditions. So check out creditcounselelite.com. That's www.creditcounselelite.com to watch a quick 10-minute video that explains more about what the heck I'm talking about and how it could best serve you. Afterwards, feel free to book a quick one-on-one call with us today, and greatly appreciate all the subscribers to Ready, Set, Go Real Estate Investing Podcast. You guys are amazing, and leaving those 5-star reviews. Keep them coming. You guys are a huge blessing. Appreciate you greatly. Share this out with somebody that needs to see it, and we'll catch you on the next episode. Till next time, God bless. Nishant, appreciate you, brother. Have a blessed day.
Thank you. Thank you, Brandon.
This has been another episode of Ready, Set, Go Real Estate Investing Podcast, brought to you by Brandon Elliott. For more information, please visit BrandonElliottInvestments.com. Also, please don't forget to like, share, and leave a comment below. Thanks again for joining. Until next time, God bless.